In 1973, Six Flags Over Georgia introduced the Great American Scream Machine. At the time, it was the tallest and fastest roller coaster in the world. Riders were pulled to the top, dropped sharply, and just when they thought the worst was behind them, there was another drop. And then it was over. Same place, different perspective. Shaken maybe, but with a story to tell. The same could be said for the economy during the Great Recession. In 2008, we experienced a dramatic drop in markets, rising unemployment, and economic uncertainty that seemed to appear overnight. Many thought the worst was behind us by the end of that year, but by March 2009, we learned there was more to come. Eventually, recovery came, but for many, the outcome depended on how well they were prepared. Today, we're seeing headlines around tariffs, volatility, and economic uncertainty. Understandably, people are asking, are we headed into another recession? The truth, no one can say for sure, but we've learned that trying to predict the next downturn is far less effective than being prepared for one. Over the past 15 years, we've gathered insight from clients and others who navigated downturns successfully, and we've seen 4 consistent themes emerge. First, buy low and sell high. It sounds simple, but emotionally it's not. During the Great Recession, many investors sold at the worst possible moment. Some abandoned their plans entirely. What made the difference? A written plan, specifically an investment policy statement, or an IPS, which helps override emotional decisions during turbulent markets. For our clients, the investment policy statement serves as a guide in these uncertain markets. It often leads to decisions that are counterintuitive, like buying when others are selling, and that discipline can make a meaningful difference in long-term outcomes. Second, debt and anxiety go hand in hand. In 2008, individuals and businesses with high debt levels were often forced into difficult decisions. Those without debt or with minimal obligations were far better positioned. We walked through the decision to pay off homes and reduce liabilities with many of our clients, and we consistently hear the same thing. They're glad they did this. Yes, one can make a financial argument for keeping certain debts, including hanging on to low-interest mortgages, but in challenging times, the psychological and practical benefits of being debt-free can sometimes outweigh the math. Third, liquidity creates options. During the last crisis, many assets like real estate, private equity, or small businesses became almost impossible to sell. Even those with little or no debt found themselves stuck. Those who maintained cash reserves and kept fixed costs low were able to adapt. In fact, some were able to purchase assets at a discount and strengthen their long-term position, sometimes creating significant wealth for themselves and their families. Fourth, in every downturn there is an opportunity. It might be tax loss harvesting, it might be purchasing undervalued investments, or it might be as simple as refinancing debt if interest rates go lower. But in each case, preparedness is key, and so is perspective. Markets will fluctuate. The question is whether there is a plan that allows us to respond thoughtfully, not react impulsively. There's a temptation in every market cycle to believe this time is different. But history has shown that while each crisis has unique causes, the patterns of fear, reaction, and recovery can be remarkably consistent. If you already have a plan, review it. If you don't, now is the time to build one. The worst time to come up with a fire drill is when the fire has already started. We can't control what happens in the economy, but we can control how prepared we are in all economic conditions. Let me know what you think of this topic. Thanks for watching.